All right. Okay. Well, since we've got a fair few people on the line, let me just get started and kick off officially. Welcome, everybody. Thank you for joining us today for today's webinar. My name's Paul Cam, and I'm a client advisor here at Oreana Financial Services. Oreana is a wealth management firm with a presence in Australia, Hong Kong, and Singapore, and now with over 7 billion under advice within the region. So today we have Dr. Isaac Poole, Global CIO for Oreana, presenting. So before Oreana, Isaac has a distinguished career through the Reserve Bank of Australia, the New South Wales Treasury, and the global risk consultancy Towers Watson, which was recently acquired by Aon. So the US election, what a journey it has been. So Trump being confirmed with coronavirus on October the 3rd, to the New York Post email saga on October the 22nd that was managed by Twitter and Facebook. This election has not been short of attention-grabbing moments. But today, we're here to look beyond the immediate buzz of the moment and focus on the issues that will matter once the dust has settled. So as I said earlier, a little bit of housekeeping. Feel free to message me via the chat function directly. If there's anything you'd like, we can make this a little bit more interactive during Isaac's presentation. And we will have a time for question and answers towards the end. So without further ado, I'll hand the time over to Isaac.
Great. Thanks, Paul. Thank you, everybody, for joining us. Thanks for the guys who joined earlier and got a little bit of a casual chat with us. That's great. You will have heard that I'm down in Tasmania at the moment in Burnie, out of the way of a lot of the big things happening in the world. But that has given me a chance to sort of step back and have a look at what the election means. And it's been an intense few days, first leading into the election, the week leading into the election, as the election unfolded, and obviously from my perspective, it would have been far easier to do this presentation if we had a result. We don't. We've just got more and more uncertainty, and that's what we're dealt with as forecasters and investors, and you'll see this over time. If you didn't hear earlier, this was always a pretty likely outcome. So we have had time to prepare, but we don't know yet what the outcome will be. We may not know for some time. Let's not stop that. Let that stop us from pushing ahead with this. Some housekeeping here, but just really quickly, Paul did give an intro to myself. It's not just me at the Oreana Private Wealth investment team, or the Portfolio Advisory Services, as we call ourselves. I have a great team that helped me out and helped prepare this. So there's myself on the left, Louise and Florence, based in Hong Kong, joined us fairly recently, and Shane Hawke, who's based down in Melbourne, and is a real veteran in markets and in research and economics. You can see there we do manage about 7 billion US dollars, around 10 billion Aussie dollars, major clients across the region, and it's a real pleasure to be able to be here and talk about the election, what that means for our portfolios, what that might mean for your portfolios, what it might mean for wealth, and what it means for the outlook. So let's go. Let's go back before the election, and we'll go back a little bit. We'll go, say, to August, and there was loads to worry about back then. We had the pandemic in March, and as if that wasn't enough, there were other narratives that just kept coming up throughout the month. And here's a few of them. So the tech sector, one of them, and the concern that was coming through from the tech sector was that it really did lead the equity market recovery since the pandemic. The FANGs, you could call them the fan mags, mag fans, whatever you want to call them. I'm sure there's other names. They were storming higher. They'd rallied fast, they'd rallied hard, And while that seems like great news to some, there was real concerns in the market that they'd recovered too high, too quickly. There was worries about regulatory outcomes, and we saw some of that last week. There was concerns about could growth keep up with, could their growth keep up with what was being priced in? And just generally, there was a lot of worry that the rapid price action you'd seen in those tech stocks was completely out of sync with the economic recovery. The economic recovery was happening, but investors were probably rightly so asking, could that tech leadership continue? Would it have to switch to value and cyclical stocks? And there was a bit of a sell-off, and people said, well, there you are, we told you so. Not the only narrative. The rise of the Robinhood day trader was another one. And not everyone knows about Robinhood, although it's been a story that has been really peculiar to 2020. So Robinhood is a trading app that lets people basically day trade stock and day trade options as well, predominantly in the US. And the stories and narratives that were being linked to these Robinhood day traders were remarkable. They would buy anything and everything to make a profit, and there were heroes made every day, there were zeros made every day, but they effectively stepped in. They bought companies that were doing well in the tech sector. They bought companies that were doing poorly in airlines, cruise companies, transport, logistics, things that had no business during the pandemic. And they bought companies that were bankrupt. They didn't care. It didn't matter. As long as they were making money, they stuck with it. And they did make money, and lots of it. But at some stage back in August, those day traders began to book their profits, and they were selling down the performing stocks, and it sort of left a bit of an air pocket under the markets, and all of a sudden these concerns crept back. And then politics begins to rear its head. So the lead up to the election campaign, as it was kicking off, I suppose, the Republicans and the Democrats couldn't agree on a fourth round of stimulus. There'd been lots of stimulus, but there were these fundamental disagreements about how another round should be spent, on which states and sectors should be supported, on how that should be distributed, on what other support might be implemented beyond fiscal support and attached to that. The result was that even as the economy continued to recover, fiscal support was delayed. Even as markets had been certain that more support would come, it got delayed again. And we're now at a point where we're post-election, there's been no support announced, and we probably won't see anything until early 2021 at the earliest. And so another concern that was creeping through. Sticking on politics is US-Chinese tensions. And those of us who lived in Hong Kong for a long time, those of us based there, those of us who have been following the trade wars with the US for some time, we know this is a big issue. It didn't go away after the phase 1 trade deal was announced. It's a huge issue for investors. And it was a really big issue until suddenly over the last couple of weeks, it wasn't. And it went very quiet. And that's very much linked to this final narrative, which is the big one we're here to talk about today, but the presidential election. You'll see later on that this has this Chinese-US tension is very clearly linked to the outcome of the presidential election. So we'll get to that. But first, let's look at the election lead up. And what we're showing here is a simple chart with care of realpolitics.com, just showing the polling for general election, purely on the general election between Trump and Biden. And you can see that it was pretty steady through August and relatively steady through September. And at that stage, markets were just digesting those other narratives that I spoke about. they had other things to worry about first. US-Chinese tensions, the economic recovery, flattening, and then the re-steepening of COVID curves, and the impact the pandemic was having on markets and people and jobs. And the presidential election at that stage, I mean, it was there. People knew it was coming up, but it was just too far away at that stage for investors to really focus on, and for the media to really get their hooks into. So, I mean, we heard about it, we knew it was there. We didn't see lots of it until we get to September. And at this point in September, markets really start talking seriously about a contested election. You can see that uncertainty starts to increase, and with only 5 weeks to go, those concerns about a contested election, the media and the market narratives really begin to fire up, and that was pushed along very quickly by President Trump being admitted to hospital with COVID. And that was in early October, 2nd of October. And at that stage, the chances of President Trump being alive for the election or being fit to stand for the election were up in the air. It was quickly clear that he was in the danger zone, if you like, but he recovered very quickly, and he got back in the campaign, but that added to the uncertainty around markets, and from then on the campaign trail really heats up, and you get this cacophony of noise and uncertainty in the investment markets. It approaches fever pitch. You have the stories changing every day. The uncertainty around how the election outcome might impact markets and the economy really began to pick up. And at that stage, up until that stage, it was mostly talking about a contested election, but that changed around mid-October. You got this sudden and very quick and strong narrative coming through about a blue wave, that the Democrats were going to win under Joe Biden, and not just win, but win big, taking the White House, taking the House, taking the Senate, and it began to be reflected in markets. So this blue wave talk continued for a couple of weeks, and during this period, markets repriced, and it repriced even as the polls began to shift a little bit, not in President Trump's favor, but less out of favor with him, and that happened as we neared the election, and that talk of blue wave started to die down in the investment markets, and we were back at a stage where we started hearing a lot about a succession crisis, contested elections, militia, revolution, voter fraud, election corruption, all of these things. All of these things were being talked about in investment markets, in very serious strategic pieces. They were talked about in the media. They were discussed at a political level. And all of these discussions began to question what were the different permutations that could come through. And ultimately, at least in the markets, we got to a point where the discussion was around the election being effectively a binary outcome with very different potential impacts. And in those binary outcomes, when you see them through history, and when the market approaches these potential inflection points, you tend to see just how much investors dislike uncertainty. And in this particular case, there was a real vacuum effect around that uncertainty, and prices, and particularly equity prices, got sucked down, and they tend to get sucked down until some level of certainty is reestablished. So let's take a look at what that vacuum kind of looks like a little bit. So this chart is the S&P 500 price over the last 20 years. And you'll notice a few things. There's lots of wiggles. A few sharp drops, a few more moderate dips, and it's difficult. When you're in the market, it's really difficult at the time to know if you're in middle of a wiggle, like in 2012, a couple of wiggles there along a trend higher, or you don't really know if you're in a sharp drop like in 2020. And I mean, in 2020, by the middle of March, we knew it was a sharp drop because it happened over a couple of days. But you get the story. That was a 30% peak to trough fall. But in the middle of it, we were talking about, is this going to be a 50%? Is it an 80% fall? Are we back to the Great Depression, where 90% of people's wealth was wiped out over the course of a month or so? So, you know, even in the middle of those big sharp drops, we don't know. And similarly, we don't know if it's just a dip and grinding lower in price, like we saw after the tech wreck in 2000 to 2003. And as we approached the election, we had this period of unusual uncertainty, and markets started talking and started thinking like we're in a binary outcome with extremely different economic outlooks. And suddenly this air pocket opened up over the course of last week, and markets fell more than 5% over the course of 5 days. And we sort of, markets are stuck in there, and investors are stuck in that period saying, well, you know, this might not be that unusual. A 5% fall happens once every couple of years, but I don't like it. We don't know with certainty where we're going from here. This binary outcome's coming up. And so where do we go from here? And the question that markets were grappling with is it a wiggle? Is this the start of a sharp drop? Is it a dip? Is it a buying opportunity? Do I just wait it out? Do I sit through this? What happens if Trump wins? What happens if Biden wins? What happens if, and what happens if? And that's a really difficult environment where you can't get a lot of information from that short-term noise. And when you get those short-term noise stories, our view is it's really important to be able to step back and focus on the medium term and think about what's the overarching narrative, what's the big picture story that I can take away from this, even if the market is trying to tell me that it's a binary outcome. And and ultimately we know markets do drift higher, but a lot of wealth can be destroyed if you get the view wrong about whether this is the wiggle, the dip, the sharp drop, or just a medium term blip on an upward shaping trajectory. So we don't know the election outcome yet, unless something has changed in the last hour since I've been chatting with Poole. So that does make it harder to give you all a talk about what the outcome of the election means for your wealth, if I'm being perfectly honest. But what we can do is share with you the set of scenarios that we've been using for the last couple of months around the election, and the sensible set of election scenarios and outcomes that could happen. And for us, those scenarios really need to focus on what matters for the economy, what matters for markets, strip out the bluster, strip out the noise, strip out the media, strip out the press, and all of that circus that invariably comes with US presidential elections every 4 years, and get to the heart of the matter. You know, what really is going to matter for the US economic outlook, and what really is going to matter for equity markets, debt markets, and currencies. And so how do we do that? And how do we do that months in ahead? Well, this slide shows exactly how we thought about that. There's 3 plausible scenarios, and they're on the left-hand side. You can see 2 where the Democrats take the White House under Joe Biden. The top one where it's the blue wave, so a Democrat White House, House, and Senate. The second one where it's Joe Biden becoming president, but with the status quo in the House and the Senate, And then the third one is where President Trump regains the presidency and the status quo is continued in the House and Senate. We ignored the fourth one where the Republicans gained the House as just being too unlikely, so we could reduce the number of outcomes that we had to model and think about. The next step was to consider what the likelihood of each of these would be. And the likelihood changes. We came up with thoughts around this a few months back, but the probability does change as it becomes clearer where the policy differences are and how palatable that would be to the nation. And so we could adjust that, but it turns out that they stayed pretty stable for us. We thought it was low likelihood of a Democratic blue wave. We continue to think that. A split House and Congress seemed much more likely, regardless of who the president was. And we still don't know which of these is going to happen. That's the difficulty of managing this. But right now, the Democrat Republic outcome looks moderately more likely to me. And it seems to be the way the numbers are stacking up, at least for now. But we have this scenario, and we could then look across what those scenarios look like from a policy point of view. So let's take a look at taxes. Now, under taxes, a blue wave was always going to increase taxes. Joe Biden said as much. The Democrats stand by that. That was going to be a tax on the wealthy, a tax on business, bringing tax rates back up to where they were before President Trump took power in 2016. And so that was pretty straightforward. Joe Biden would split Congress, limited ability to impact taxes, and President Trump is an anti-taxer. He was always going to be reducing taxes. Fiscal stimulus, it's coming. That is one thing that we're fairly sure of, that no matter who takes the White House or what the permutation looks like, there will be more fiscal stimulus at some stage in early 21, and it's going to help the recovery. It might be relatively small under a Joe Biden presidency split Congress, but it will be there and it will help the economic recovery persist. Monetary policy is helicopter money. That is the case under any of these outcomes. The US Fed's been doing quantitative easing for a decade, so long that markets forget, I think, just how much liquidity can be pumped into markets. And under every scenario, this is coming and it's staying. And that's pretty important. US and China is a bipartisan issue. The US is going to be tougher on China no matter who wins. Both parties have said that. They've been saying that for some time. And that's why that news story and that narrative fizzled away over the last couple of weeks, because it became clear that it wasn't a contested issue from a policy perspective. Both parties had the same view. Climate change and trade policy, some differences. They're important for specific sectors. They're important for specific lobby groups. They're important from a sustainability and ESG perspective. So critical to be on top of, but these are longer term, slower burning issues that will impact the economy over the next 20 years, not necessarily the next 20 months. So we could attach likely outcomes to this, but for us, it's just critical to focus on the big picture. And the big picture is that monetary and fiscal policy is now and has been for some time the critical part of this economic story, not who is in the White House. Now, to give you a sense of that big picture, this is the monetary, I'm sorry that there's a chart here, I usually try and not use them, but this chart shows the monetary policy settings, the interest rate settings for some of the major economies. And you can see the red dot, which is where those policy rates are now, effectively at zero, if not below zero. And the black line is the range of where they have been over the last 10 years. They are at rock bottom. They are not moving anywhere. They're going to be at this level for the next 5 years, potentially the next 10 years. There will be more quantitative easing. Central banks around the world will continue to print money and support markets and the economy in any way that they can. They have to. And they'll keep doing it because it's working, or at least they believe that it's working. We can see that we can see that in the economic recovery that is taking place in the US. You can see it in the labor market, and the labor market is exactly what the Fed focuses on. It's exactly what governments focus on. The unemployment rate sitting pretty at 3.5% in February, surged to 14.7% in April, and then we're back at 7.9% in September. Fiscal and monetary policy is the big picture here. They are what's been driving that recovery, and they will continue to drive that recovery over the next 5 years. So for us, this is very much a focus on the big picture, strip out the noise, and think about what is going to happen to the economy over the next 5 years. Now, we're close to a result. It's not here yet. It is a contested election. That's been our base case. We were saying that earlier on. We don't know how that's going to progress in the near term. Could be through the Supreme Courts, could be the state level. It could get ugly in the short term, but that noise is back. We're back to media driving a lot of the noise around markets and around investing. That's not a good way to invest. We've seen that in the media, and it's important to try and strip that out. And why is it important to strip that out? It's because it drives near-term volatility. That noise and the uncertainty is something that markets abhor. And so get ready for it. Know that it's coming. It could persist for some time, but it's not the big picture. The big picture is that this contested result is not going to knock the US economy off its path to a sustainable, durable, gradual, and lengthy recovery. We think that could be, over the next 5 years, a continual recovery. It could be very powerful over the next 12 months or 24 months. We're coming off a deep contraction. And that means growth rates could be surprisingly and remarkably high next year. And once we're past the election, that's what markets will focus on. They'll forget about the contested election. They'll forget about who lost. It'll be all about that growth story being driven by monetary policy largesse and fiscal policy largesse. And that is a great news story for investors. It's a tailwind to economic growth. It's a tailwind to equity prices. It's a tailwind to growth assets. And that is the big picture story, that it's important here, not who's occupying the White House, because that will have impacts around the edge, but it's not going to stop the US economy from recovering. So that's all great. What does it mean for portfolios? What does it mean for your wealth? This is a document that we put out every month. It's our asset allocation review bite size. We summarize at a high level our thoughts across a range of asset classes. It takes about 2 minutes to read through. It gives you a high level overview of where we think the opportunities are. You can always come and discuss it with the advisors or get in touch with us. It reflects how we manage our portfolios. It reflects how we manage our wealth. And it's comprehensive, and it's backed by some very deep research on, more specifically, on the asset classes themselves. But you can see here that in terms of where we're thinking that big picture drives is a bullish story for growth assets, a bullish story for US equities. It's equity returns that look stronger than history over the next 5 years, strong average returns. It's caution around sovereign debt. There is a lot of it being issued. There's a lot of it being purchased by the US Fed. There's more of it coming. That will be inflationary. It'll be growth supporting. Yields are going to drift higher. The time for buying government bonds was 6 months ago, 12 months ago when we started buying them. Now is not the time for that. And it's positive for you, corporate America. Corporate America has been issuing debt like crazy. The Fed has helped because they've been buying it. The Fed has helped because there's been liquidity coming through. That's not changing. It will be somewhat less supportive if it is the blue wave, because taxes will increase, but that'll be offset by fiscal stimulus and very, very powerful fiscal stimulus. So no matter what the scenario, that underlying story is a positive one for corporate America, and returns that look pretty strong. Now, we think that over the next 5 years, the US dollar could come under some pressure as a result of all of these. And when rates are very low, the dollar, and the US dollar in particular, tends to be the pressure release valve for all of these concerns and all of these market movements. And right now we're a little bit concerned that it may continue to weaken, not aggressively, but drift lower. We're sitting in Hong Kong. I'm in Burnie, Tasmania at the moment, but for our clients and our friends on the line who are in Hong Kong, obviously we're US dollar investors by default. And so it's important to think about this when you're setting your portfolio, and think deeply, because when rates are this low and they're not moving, the US dollar is going to have an impact on your returns. And it's important to have a clear view around that. So I'm gonna pause there. I had half an hour. I think I've hit that almost on the head. And I'll throw over to Paul to facilitate some questions.
Thanks for that, Isaac. Yeah, so I've got a few questions, and thank you to everyone who's shot them across. I'll start off with a big one just on quantitative easing. So today we had news from the Bank of England in terms of them ramping up theirs. On Cup Day in Australia, we had the RBA talk about it. So there is so much liquidity floating around. So, I mean, just from a high level, maybe you can help us understand how is the world absorbing all this printed money, and is there a new paradigm that we need to look at in terms of how financial assets will be as a store of our wealth?
Yeah, it's a great and important question. Quantitative easing sort of kicked off a decade ago or so, and really has been one of the key policy shifts over the last couple of decades. Quantitative easing is a bit unusual because what the Fed is really trying to do, and what central banks are really trying to do with quantitative easing, is shift people out the risk curve. They want people to stop saving cash. They don't care if savers and retirees are getting 25 basis points, minus 25 basis points on their cash savings, because what they're interested in is supporting the economy, getting inflation back, and they do that by forcing savers via pension funds or via their own wealth to move out the risk curve into equities, into corporate credit, and other assets that have a risk premium attached to them. Now, that's great for the economy and great for the Fed, because it effectively is increasing wealth, because people buy those risky assets, pensioners feel wealthier, savers feel wealthier, and they start spending, and one person's spending is another person's income, and that wealth effect and spending effect is what they hope will push the economy higher and strengthen the economy. It's also great because it allows inflation expectations to pick up, and ultimately, while central banks are comfortable with interest rates at zero and they're comfortable in implementing quantitative easing, they don't want to do it forever. So they want those inflation expectations to drift higher so that they can start hiking rates again and hike rates into a wealthier, more inflationary economy. So that's their goal. It's stated in some of the research papers. It's stated in some of the minutes. It's stated in discussion groups. And it worked really, really well in the period 2010 through to 2020. You'd have to say that multi-1,000% increase in the S&P 500 between 2009 March at its trough and the peak earlier this year is evidence, at least, that quantitative easing did help asset prices, did help wealth, and we did see inflation picking up before the pandemic hit. So yes, it's important to be aware of it and important to be aware of what the central banks want to do. Managing money and building that into your portfolio, really critical, because if you don't adjust the way you model that, if you don't think about it, you'll have the wrong trigger levels and the wrong levels for your return targets for equities, and it all becomes it all starts to break away. So we do think a lot about it, and we think that it's here to stay. We think that will help equity prices drift higher over the next 5 years.
Great. Next question, do you see the US dollar hegemony remaining, given how divided this election has left the US? In particular, are there any early warning signs you can share when deciding whether there'll be a shift away from the US dollar?
Yeah, it will happen over time, and over a time that is longer than medium term, but shorter than the very, very long term. The US dollar is still the currency of the global risk-free rate. Now that risk-free rate is effectively zero, but it's still the one where if you buy a government bond, you know you're getting it back no matter what. Now that can and probably will shift over time, and the Chinese currency, the RMB, is a currency that a lot of people have talked about becoming a new global currency, and the Chinese government would certainly love it to be a global reserve currency that people will trade in and mark their exports and imports in and accept as a global currency. It's not there yet. It's not there yet because it's not fully free floating. It's still a partially managed currency. And until that changes, it's not going to be a global currency. Until the capital markets in China have completely liberalized, it's not going to be the global reserve currency. And I think alongside that, it's not necessarily going to be the case that it will be US or RMB as the global reserve currency. Both of them can play that role, but we're some time off.
Okay, cool. Regardless of which administration, will there be any difference in terms of how they will deal with the China issue?
Limited difference, I think, from a practical perspective. They will be tougher on China, and that's been made clear by both parties. The firmness and sort of in-your-face methods of President Trump's administration may be somewhat more moderate under a Joe Biden-led presidency, but it will still be much firmer than what we would have been used to under previous Democratic administrations. That being said, what appears, I mean, it's going to be the same from the US perspective. It may be different from China's perspective, and I think what we've seen over the last couple of weeks after the plenum is China is pushing ahead with the liberalization of its financial markets, and it's really opening the door and opening its arms wide to Wall Street to say, come on in, you can get ownership of firms in here, you can easily access capital, you can have far freer entry and exit in our capital market systems, the rule of law is clearer. All of those is bringing China and US financial markets closer, even as political markets and perhaps the goods market are being wedged apart a little bit. So I think you could have this system over the next 5 years where financial markets liberalize and become more closely intertwined, even while the political system is held a little bit more at arm's length. Okay,
cool. Last question from me. So when you and I chatted, as like you said, the key metric that you're looking for is sort of fundamentally are jobs, jobs, and jobs. Before Biden didn't have control of the Senate, he said he wanted to create 1 million jobs in the auto industry. And given how everything's unfolded, how do you think the state of play will affect job creation?
Yeah, jobs are so critical to an economic recovery. And in the past, jobs recoveries have been very slow and very gradual. This time it is different. You saw the numbers there, the unemployment rate dropping from 14.7% down to 7.9% in a very short period of time. That sort of a recovery in the past might have taken 3 or 4 years. So that momentum is there. It will continue to build on itself and be self-sustaining unless one of the two administrations does something unfathomable and implements a policy that destroys jobs. I don't think either of them are talking about doing that, and certainly Joe Biden's goal of more and more jobs and desire to implement more and more fiscal stimulus suggests that he's very much on board with that. Obviously, so is President Trump. He wants those jobs to recover. He's clearly on board with fiscal stimulus, and unless we have a complete shift in mindset from one or both of them, that job creation and that job recovery is going to happen. It could be in sectors that might be a bit unexpected, so it may not necessarily be in the automobile industry, just given preferences may change post pandemic to driving and to the type of cars that are made in the US, but those jobs will come back, and I suspect they'll come back faster than they have in previous recessions.
Yeah, well, that's certainly a very positive message, and hopefully we'll keep the US together a little bit more than what we're seeing. Actually, there was one more question. Is COVID and further lockdowns no longer an issue for global markets? Biden has made noise about a different stance to Trump, and UK looking at further lockdowns. Is this priced in, and are markets just looking past COVID?
Yeah, that's a great question, and I haven't focused a lot on COVID in this, but it's clearly one of the critical global risks. Now, I don't focus on it a lot because from a purely viral perspective, I have nothing much to add as an expert. I don't know if it will mutate further. I don't know if it will ease off. I don't know if we'll have a vaccine over the next month, 2 months, 6 months, year. All of those are still pretty unknown to me. I can say from a probability point of view, a vaccine is closer now than it was 6 months ago. That's kind of not profound. It's just obvious. The fatality rate seems to have eased off in the most recent waves. Again, just a statistical point, but people are still dying. And governments are more targeted in their restrictions, and the appetite from those governments to implement widespread economy-killing lockdowns seems to be far less than it was 6 months ago. So the situation appears to be that there will be more restrictions, but not as aggressive. Growth will recover slower than otherwise would be the case under the economy remaining wide open or under a vaccine being found very quickly. But it's still a risk. Has it been priced in fully by markets? I'd say not. So if there's a mutation, if there are widespread blanket lockdowns across Europe, the UK, the US, Australia, China, or Japan, all of those would impact the global recovery and would be a challenge, and it's not fully priced in. It's not our base case. It is something we think a lot about. It's a downside risk, not a tail risk. This is not 0.5 of 0.5%. It's something that might be a 5 or 10% probability, so meaningful, and certainly something that we build into the scenario and stress testing that we do around our portfolios.
Great. Well, let's hope the situation improves, but otherwise there's another month or so in Europe to endure. So that wraps up the questions. So first of all, on behalf of everybody here, I'd like to thank Isaac for his time and expertise. Any further questions, feel free to contact us and we'll do our best to answer. Otherwise, thanking everybody for your time in attendance, and we'll see you again next time.